Hello, my name is Carolina Guzman, and I'm going to share with you my experience building financial products with alternative data scores using machine learning models. So about me, I was born in Colombia and I've lived there most of my life. But since January in this year, I came to Barcelona to study a master's degree in digital product management. Why? Because I'm a person who is interested in or is moved by or passionate about creating social impact. I have a huge sense of responsibility. I like to fix problems. I like to observe and understand the cause of those problems and the cause of the people's needs. I love to work in teams and call to action, and so we can go together and build a different situation for the people in need. And I'm an achiever, so I'm really focused on delivering. So let's go into the problem of financial inclusion or financial exclusion. So I want you to think for a moment, how many banking or financial products have you used in your life? And what have you used them for? Think for a moment. How many savings accounts have you had? How many checking accounts? Digital wallets, debit cards, credit cards, personal loans, student loans, auto loans, mortgage loans, insurances, life insurances, death insurances, car insurances, property insurances, and so on. Probably you said 3 to 5 times this, I have this, or I have had this. In my case, I have a savings account or many savings accounts. I use several digital wallets. I have a debit card for each of my savings account. I have many credit cards, personal loans, student loans. I used to have an auto loan. I used to have a mortgage loan. I have a life insurance, and I used to have a car insurance. So in my case, and I believe in your case also, banking or financial products are part of your day-to-day life. So now imagine, how would your life be without any of these? Think for a minute. Where would you receive your monthly salary payment if you don't have any savings account or checking account or digital wallet? You would need it to be paid in cash, no? Or how would you pay all your bills and send money to others? Also in cash. How would you book an airplane ticket or a hotel room? Difficult. I don't know if a hotel can book a room just by a phone call if you don't have a credit card. How would you use your day-to-day mobile applications like Spotify, Netflix? How would they charge you if you don't have a credit card or a debit card? How would you pay a sudden damage in your property if you are not able to pay it with your monthly income? For example, there's a water leak in your roof and you need to fix it. But this leak is not a small leak, or it's a big leak. So you need to find that money. Who are you going to ask that money to? And how would you pay for your house and your studies and your car and your dreams? Think for a moment. So I want to present to you 1.7 billion adults that don't have all that. They lack an account, and after lacking an account, they lack access to credit, access to insurances, access to credit cards. What does that mean? That they cannot save money in a safe way. They don't have access to small loans or credit lines. They can't build a credit record. They can't receive or send money, only cash in hand. They cannot make payments in a safe, reliable, and convenient way. They can't access a whole offering of digital products and services because they don't have a credit card. Why? The main causes of financial exclusion are, first, geography. Usually, the unbanked population lives in slums, or they live in faraway villages or outside the cities, where it's hard to reach with traditional branches, bank branches, because they lack of formal education. Many of them didn't go to school. So that also is a factor to financial exclusion. Third, that traditional products don't meet their needs. A traditional bank account will charge every month for a managed fee and will charge for every withdrawal. And it will charge for an emission of the debit card and so on. And for this population that have low income, it's impossible to pay just for having the money in a bank. So what happens? Cash becomes the king. And with that, what happens in the bank? You go to the bank and the bank would say, you don't have no financial records. I can know who you are, your debts, and your punctuality. Bring me a work certificate. If you don't have a work certificate, I can't know how much you earn. I need somebody to tell me this person earns this amount of money per day, per week, per month. But what happens with the unbanked population is that they are informal workers. The global fee index, that is the source of the previous image of the unbanked population around the world, states that half of the unbanked population are informal workers, and the other half are unemployed. So with that, we have a huge challenge. That is, how can we acknowledge or how can we prove that informal workers do have an income? And why banks ask for this? Because banks are regulated, because they have our money, our savings money. And they cannot approve risky loans because the regulation says, since you have the money of the public, you can only invest that money in low risk operations. And lending money to a person that a bank doesn't know anything about is a very risky operation. So what does bank say? I cannot borrow you money. However, there are new trends reducing the unbanked population, but still they are not unbanked because they have a bank account, but they are underbanked because they don't have access to credit. What are those trends? First, COVID is not a trend, but it's a fact. 2 years with several effects on our economy. People were obliged or pushed to use different means, digital means, in order to connect with everybody, in order to transfer funds, in order to get paid. So that helped a lot. Also, the smartphones penetration also the increase of internet access, but still, even after the pandemics, 2.9 billion people around the world have no access to internet. The pandemic helped, but what the UN says is that the people that have access to internet, like the new users, they have access to internet because they are using another person's smartphone, or because they are going to the store, the shop next door, and they are renting time there to be on a computer. So they go online once a week, twice a month, and usually they don't use their own credentials. They use the user of other person or a friend or a familiar. So this is still a problem. Virtual debit cards can be used to purchase online. That's a good thing for people that don't have a credit card. And this is very important, online boarding, because you can now open an account from your phone. You can log in with a selfie or answering like questions that you only know regarding where were you born, etc., that can help institutions to know that the people that is onboarding online is the person that they say they are. So what are the main barriers for the underbanked? Let's say they have an account, but they need a loan. What are the barriers? So now let's suppose that you are home and a stranger rings your doorbell. You're watching TV and suddenly the bell rings. You open the door and there's a woman and she says, "Hello, my name is Mary and I need a loan of $1,000. Could you please help me?" What would you say? Like, what? I don't know you. No? So what would you need to know to lend her the money? Think for a moment. And how can you be sure that she's going to pay you back? This is the situation of the bank. We're just playing to be the bank here. So the main question is, can we make them non-strangers? How can we do that? What would you need to know to lend her the money, to lend Mary the money? So first, ask questions, no? Ask questions about her personal life, especially how many dependents does she have, how to reach her, where does she live, who does she live with. Also ask for her, say, financial situation, her job, income, expenses, other debts, and very important, what is the loan for? But after all these questions, and say Mary answers every question very, very good, how can you be sure that she's being honest and that she's going to pay you back? That is more important. What tools do you have in hand? So how to be sure? And here is where artificial intelligence and machine learning models take part. So we have three, or in my work back at the bank where I used to work, we found three main sources of information of our clients. First, there are some personality traits that can predict a person's behavior with a loan. And in this case, Mary's behavior. First. Second, the digital footprint, or how Mary behaves in the digital world, can predict her behavior with loans. Very interesting. And third, social networks can also help. Maybe some of your friends know Mary, or can you ask some of your friends what concept do they have of her? Probably somebody says, yes, I know Mary, and we have been friends for the last 2 years. And yes, she works at this place and she earns around this money. And yeah, I trust her. She's very, very reliable. That would help, no? So let's see each of these sources of information. So first one, the personality assessment. Personality is the sum of all the psychic characteristics of a person that determine how that person would behave in a given situation. Regarding a person's financial behavior, some personality traits can predict their financial discipline to save or to pay a loan, like impulsiveness, locus of control, and patience. And research shows that a higher perception of control, less impulsiveness, and more patience are related to a better financial behavior. So, how can we know if Mary is impulsive or is patient or not? With a psychometric test. A psychometric test, and depending on the psychometric test that you use, you can assess the personality of a person. And in this case, you can assess those personality traits that are important for financial behavior. Okay, so please have that in mind. And then the digital footprint. Take a moment to think the amount and kind of data that can be gathered based on your smartphone. Number of calls, incoming and outgoing, time of the calls, duration of the calls, who is calling you, who you are calling to, number of contacts, location of those contacts, number of applications that you have on your mobile, type of applications for money management, time management, feed apps or to chat with your friends and family, social media apps. How often do you use them? For how long do you use them? What are the most used apps on a day? Movement. If you move daily, if you are commuting to your place of work, or if you stay in the same place the whole day and the whole week, or you move a little, or you travel a lot. Activity on your phone, the phone model, the battery level, and of course, airtime. How often do you buy airtime, if it's your case? So, as the personality assessment, machine learning models can predict which levels of usage of a smartphone are compatible with a good financial behavior. And machine learning models can predict which levels of personality traits are compatible with a good financial behavior. But these machine learning models need sound calibration in order to be accurate. And here is the challenge. The more the better, but at least 5,000 observations, that is, disbursed loans, are needed in order to calibrate the model. And this has to happen in a specific territory with a population that shares the same cultural background. So what we need here is 5,000 people would ask for a loan. And when asking for a loan, these clients should first go through with the personality assessment with a psychometric test. And second, give permissions to access the smartphone data. Then they will access the loan, they will receive the money or the disbursement, and they will be payback. And what happened with this? The model will learn who will pay good. Like what kind of profiles made of digital data and psychometric data are persons that behave as you expect. That means that pay punctually. So this is how the machine learning models can help us with financial inclusion. And third, the social networks. So have you ever thought about how much is your reputation worth? The unbanked usually live in neighborhoods where close relationships between neighbors is key to survive. Reputation is much more valuable for the unbanked since they live in low-income communities where social networks provide all kinds of support. And as I was saying before, your neighbor is your first lifesaver in a case of an emergency. So after many transactions between members of those social networks that are built in neighborhoods, they all know, all the members of those social networks know how reliable each of them is. The point here is how can we convert these relationships into digital data? All these transactions, day-to-day transactions into digital data doesn't exist. And social media is not an option because, I don't know, maybe research have to be done there, but social media doesn't count for transaction, like for this kind of interactions, personal interactions that neighbors have in a neighborhood. So at the bank where I used to work, Banco Social, we did an experiment with this. We went to the field to find community leaders who knew well who in their network would need a loan and who of them were able to pay back the loan. So persons like this woman there would help her neighbors to access loans. Like, for example, Mario. Mario would need a loan to fix the roofs of his house. So Mario would download this application, Solución Amiga, where he could save in Alcancía Amiga. He could access insurance, go to information, but more important, and what we are interested here is he would be able to ask for a credit or a loan in his phone. So there, when he pinched there in credit, he would answer some common questions, as we saw, like about financial situation, personal situation. He would answer a psychometric test. A psychometric score would be calculated. He would give permission to the bank to gather digital data in order to assess a digital score. The bank would consult credit bureaus in order to gather additional information, like does Mario have a bank account, how long ago, etc., etc. And Mario will have an immediate answer and disbursement if the loan was approved. All this with just a promissory note, that is a promise that Mario is making with the bank to pay back the loan. What was the result? We found many community leaders who were promoters in this community. Our pilot was with 30 community leaders who found hundreds of clients who needed a loan. But those clients, unfortunately, were not able to complete the process in the app. This was in 2018 and beginning of 2019. And by that time, the technology was not adequate to support the integration of two parties in a mobile application, because we had a fintech that provided these scores, psychometric score and a digital score, and the bank. And these were very difficult to integrate. And after that, the pandemic came and everything changed. And after that, there was a major change in the regulatory framework in Colombia. And the credit that we have built in this application was no longer viable due to the new regulatory framework. So we have to stop. However, we have very good key learnings. The first one, the unbanked and the underbanked population are demanding convenient and reliable credit products. Meanwhile, they only have the loan sharks who charge extremely high interest rates as of 1,000% annually. And this is the only option they have, the loan shark. And that's why it's important to advance new research and new experiments in this field, because loan sharks are stopping the unbanked population of overcoming poverty. They're stuck with those loans. Okay, another key learning. Psychometric and digital scores are being provided by fintechs as before, but they are being used by banks, traditional banks, to increase their operations with bank populations. This is the major trend. Probably there are some special cases that I would love to know. If you know, let me know. But this is the what is happening mostly. Today, APIs are common in every tech-based organization, in banks. Even Banco Casa Social have a whole integration with other with other companies via APIs. So integration should be smoother. And financial regulation needs to be wide and steady. Otherwise, players won't have the right incentives to innovate and reach the unbanked. So the fintechs and banks should be able to move in a safe regulatory framework. Because if this framework is changing every time, it's not possible to advance. And what are the next steps? Well, I would love to find funding to run the experiment again, outside the bank, of course, but with new partners and with the right tools and with the right partners. Please let me know if you are interested. Any questions? And here are here's my email address and my LinkedIn address. I will be glad to hear from you. Thank you very much.